is Tesla one of the easiest companies in the stock market to 10 times your initial investment? We're going to find out in today's episode, but we do have Cathie Wood, who believes that this company will be worth $2,600 in 5 years' time. This is a company that is currently valued around $179. Now, everything isn't as bullish as she makes it out to be. We are on the eve of finding out whether or not Elon Musk's compensation package will be agreed, and that will bring its own issues if we are to find out that is not the case. We can also see that even though Cathie Wood is really relying on the robo-taxis, that JP Morgan does not believe that this will be the case for many years, so something to discuss on the episode. And we can see that on the 8th of August, so not too long to go now, that Elon Musk did tweet that the robo-taxi will be unveiled, so we will get a lot more information. All of this we're going to deep dive in today's episode, and as always we're going to run Tesla into our stock analysis model, getting to our intrinsic value, finding out what is our acceptable buy price in today's market, what is the margin of safety as well that we can incorporate, and what do Wall Street themselves believe the share price will be over the next 12 months. And don't forget, what we're going to do in today's episode is not only are we going to run through 3 different estimates for the forward-looking low, medium, and high, but we're also going to explain to you what type of free cash flow growth rate that Tesla will need so they can satisfy Cathie Wood's $2,000 plus share price to understand whether or not this is even realistic. Now, as part of this analysis, we are also going to deep dive into some of their underlying metrics, looking at their free cash flow, their debt levels, and we're also going to do a deep dive on their numbers to understand where this company has been over the last 10 years on their top line as well as their bottom line net income, as well as taking a look at this company's health, quick total cash versus total debt, whilst also understanding what the insiders are doing. We note a lot of insider selling just over the last few weeks, as well as what the institutions are doing as well. So let's jump into our analysis today. Now, Tesla, as you will have known, has been down horrifically over the last 12 months, down 28%. In fact, year to date, they are down 31%. But if you have been a long-term shareholder and you haven't let any of that phase you, you would be up over 1,000%. Although we do note that this company did hit all-time highs at just over $400, but we are talking about nearly 3 years ago today. Now, in terms of where it's currently sitting, well, we can see it is towards the mid to lower end of the 52-week range. We do get a triple hold rating, that is Seeking Alpha, that is Wall Street, that is Quant, all declaring this is a company that isn't a buy, but isn't also a sell. And we do note the forward P is around 67.17, but we also understand some companies, it is a little bit more difficult to value them on this model, especially when you have a lot of catalysts that are upcoming, like the robo-taxis as well as Optimus, which we haven't touched upon today. So moving on to the numbers and understanding what is going on, well, we first want to draw your attention to the insider ownership. Does sit very high, 21%, and that is in relation to other companies we've reviewed on the channel. 5 insiders that have sold over the last 12 months for a whopping $79 million. In fact, you only need to go to this quarter to note $19 million worth of sales, and in quarter 1, $37 million. So 2024 this year, we can have a look at these insiders who have been selling. Notably, or the more recent one, we have the SVP as well as the director who sold on the 6th of May, as well as the SVP who sold on the 6th of June, both for a significant number of shares. In fact, the director sold just over 93,000 shares for a total of $17 million. So that is quite bearish, although it does depend on what you believe. Personally, for me, it isn't a bearish signal just because we don't know why they sell, whether it's personal or financial reasons, but a lot of people will put that into their investment thesis, so that information is there. We are transparent. You can see both buys and sells. Now, in terms of looking at the same information for the institutions, we note 66.2% institutional ownership. Now, $37.94 billion worth of sales by the institutions over the last 12 months. We do note buying, however, it is a lot lower over the same period, and as well as that, we can see in quarter 1, so the more recent data from the institutions, that they have been selling more than they have been buying. So to conclude this aspect of the analysis, what we can in fact see is that institutions have been selling more over the last 12 months, as well as the more recent quarter, as well as insiders have been selling heavily just in 2024 alone. Now, what we also want to draw to your attention whilst we're running through the numbers is the information we did allude to earlier, and we can see Cathie Wood, so part of the ARK investment management team, do have their eyes set around $2,600 as the price in the next 5 years, with the main driver and catalyst for this being the robo-taxis, now that they clearly account 90% of Tesla's business within this model that they have initiated. So that is quite high. Again, as we can see, this article is a little bit late in terms of the share price. It is up on the day nearly 5%, but that essentially means a more than 1,400% increase. So that is a 14x from the current trading price, $2,600 per share. Now, if we also take a look, we can in fact see that that is their estimated medium. However, they do believe a bullish estimate would be around 3,100. They give it around a 25% of occurring, but nice for them as well. They have also done a bearish estimate for around $2,000 per share. Again, they believe 25% chance of happening. Now, we're not here to say whether or not it will happen. We just want to put all of the information there, but you will come towards the end of the episode where we will say and look at the numbers that are needed for this to actually be executed. Now, we also just want to touch upon some bearish news. Now, Elon Musk is essentially nervously waiting to find out whether or not he will be getting that $15 billion pay package deal that was agreed to him not too long ago. Now, this is something that we are waiting for. There is a lot of bearish indicators with people believing that he will leave if he does not get this pay package accepted. But again, we can wait and see. This isn't too long to go now before we get the results of this. And we can also see, in fact, JP Morgan do not believe that these self-driving robotaxis will be yet for another few years, which is a little bit on contrary to what Cathie Woods believes. She does see essentially this taking place in the near future, within the next 5 years. In fact, that share price will be driven by 90% of Tesla's top line being due to the robo-taxis. Let me know, though, as we go along, whether or not you do agree with a lot of these assumptions as well as these catalysts. And as we pointed out, not long to go, the 8th of August, to find out what exactly is happening with the robo-taxi. Not much has been leaked just yet. So again, this will be very exciting, especially for those shareholders who have believed in this company for quite some time and have in fact been rewarded, as we saw the share price over the last 10 years, even though it was a bit of a roller coaster, still up over 1,000%. And what we also wanted to draw to your attention is the FSD. Now, this is effectively the full self-driving subscription. Now, they did in fact reduce this. It was around $200 per month. We do note now it is around $99 per month, and something that will help bolster their top line revenue, as we are about to find out when looking at their numbers in our quick deep dive. Now, also, before we do move into the numbers, quite interesting to note that the actual add-on for the Tesla's full self-driving, similar to their car prices where they have increased it and then reduced it, we can in fact see around 5 years ago this was costed around $5,000. We do note now, whilst it had pretty much peaked up into September 22 at $15,000, it has recently had a cut to $8,000. So again, whilst essentially the car prices are increasing and decreasing across the board, something very similar happening with the FSD. Doesn't give me a lot of confidence when we do see a lot of price movement, but again, there could be some valid reasons, and as always, we're not privy to all of that information. Now, before we just jump into the numbers, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, do click on that pinned comment below to sign up and read straight away. For example, if you want to find out how we find undervalued stocks, we have all the resources, all the screeners in this article, or one of our more recent articles where we run through 12 high-quality undervalued dividend stocks. So let's jump into the numbers. Now, as just a quick update, we can see that it is over 5% up on the day, so we aren't too far along to seeing where that compensation package will be accepted or not, and we would expect that the price will go up if it is accepted, and most likely go down if it isn't. So in terms of their numbers, top line revenue, yes, typically 3 to 7% as a baseline. However, with Tesla, a fast growing company, $3.2 billion reported in December 2014, $97 billion in December 2023. Massive growth across the board, and in fact, we pretty much see nearly every single year large increases. Hopefully, this will continue. There were some drivers, some catalysts that we have talked about, but also some bearish indicators, so things to consider. But as always, based on the data that we can see, the growth has been very strong so far and historically. In terms of the bottom line, well, we can see just purely looking at a graphical basis, it wasn't until December 2021, so not too long ago, where they reported their first net income as opposed to a net loss from the previous years, and we can see it has been increasing over the last 3 years. Hopefully this will continue as well. It will be interesting to see how the robo-taxis does affect both top line and bottom line, whether or not they will be a loss leader initially to begin with. We then move on to essentially the balance sheet, a quick health check. 1.9 billion in December 2014, 27 billion in their latest quarterly report. We can see their cash position has been increasing over the longer term, and whilst we would say there's a very healthy amount to be sitting there, in isolation that number really means nothing, which is why we always compare it to our total debt numerically and directionally. 2.5 billion, as we can see here, December 2014. When we take a look at their debt now, 9.9 billion. So two things to note. One, yes, it has increased over the longer term, but the second thing to note, their cash position is much larger than their total debt. So if they really wanted to, it wouldn't even take them one day to pay off all of that debt net of cash on hand. So no worries with that in our opinion. We then take a look at their earnings. Now they will be reporting their earnings not in the distant future. And one thing we always like to look at is their track record. Now over the last 4 quarters, they've only beaten one. So that is a 25% track record. Not looking great. The last 3 that they've had, they have missed, although you could argue marginally. So not something that does give you confidence moving into the next quarter earnings. And in fact, quarter 2, the EPS is anticipated double-digit decrease year on year. And even the next quarter after that single-digit increase, you have to go all the way to Q1 to see massive increase to that as well. Forward looking though, they're anticipating 350 for December 2025. That would lower the forward P to around 48.73. Interesting to note, something just to consider, but again, whether or not you include this information, completely up to you. We just show you the facts and figures. In terms of the valuation, well, no surprises while they do get an FAP on a non-GAAP basis, 67 is incredibly high, but then again, you could look at the sector median, 15.88. They are trading at a massive premium, 323%. A lot of people will argue that actually that is justified due to the growth, due to the profitability, which we are going to go into now and find out. But again, whichever method that you do use to value this company, you can see it is very poor against the sector median, which is this column here. But again, it really does depend what companies are grouped within this sector as well. If they aren't comparables, then really this information isn't that relevant. We then take a look at their growth grade. Well, they get a C-. Now, in terms of year-on-year growth, 10% historical growth, a lot better than the sector median of single low digit. Forward looking, 13%, sector median 3.6. So again, we can see a lot better even moving forwards. And one thing that we always like to draw your attention to is that earnings per share on a forward basis. 11.2%, pretty much similar to what the industry as a whole is expecting, 11.32, and that is compounded annual growth rate year on year over the next 3 to 5 years. So again, there are other metrics here that if you do prefer, you can take a look, but overall they do get a C- on the growth grade. Now finally, the profitability, well, an A+, gross profit margin 17.8, not that great, and when you do compare it to the sector median, in fact, it is very low, 36.7 with others in that same industry. In terms of the bottom line, though, it is better, 14.4. We can see the sector as a whole, 4.78. Finally, the other thing that we like to look at is their cash from operations, just under 11 billion, as we can see, sector not even at that 1 billion mark. So some things to think about there, some positives, some things that may get you thinking. And in terms of a conclusion for this part of the analysis, a triple hold, seeking alpha, Wall Street quant, an F for valuation, C- for growth, and an A+ for profitability. In terms of that sector, how do they compare in terms of their performance? We have others in the automobile manufacturers, Toyota, Stellantis, Ferrari, some very big names, Mercedes as well. Over the last year, well, Tesla the worst performing, or if not one of the worst, negative 28%. Over the last 5 years, though, they have been one of the best, completely outperforming those competitors. And if you do extend it over the last 10 years, again, a very similar result, a very incredible performance. In fact, the only one that does come anywhere close is Ferrari, ticker symbol RACE, at 716%. Now, just because they have performed that well, it doesn't mean they will perform that well again over the next 10 years, but just something to consider as we can see here. Now, when we move on to the S&P 500 comparison, what we note over the last year, S&P up 24%, Tesla in fact down 32%. When we expand this to over the last 5 years, in fact, we see Tesla completely blowing it out of the water. And again, no surprises, the same result there over the last 10 years. Do let me know your thoughts though. Do you believe that Tesla will outperform again over the next 10 years? Or do you see this slowing down, even with some catalysts like Optimus, like essentially the robo-taxi FSD as well. One thing that we want to do before we jump into the valuation is look at some of their underlying metrics. The first one that we look at is the free cash flow. We want to see growth over the longer period. And what we know, 2014 to 2018, negative on the free cash flow per share. Since then, it has been increasing, although it did peak in 2022 and is expected 137 in 23 to move up slightly to 163 in 2024. So do bear that in mind, as that will form part of our analysis when we do come to value this company. Sales growth, as always, for companies that are growing at a very rapid rate, the one consideration we need is to understand whether or not this growth will slow down. And what we can see over the longer term, it has started to decrease. In fact, peaking at 2021 in the more recent period, dropping down to 19%, trailing 12 month at 10%. So this is definitely something that we should consider. But again, there are lots of catalysts that could really help jumpstart this back into the high numbers that we have seen in 2021, as well as 2016 to 2018. In terms of total sales, while we looked at this, just another format to what we looked at earlier. Shares outstanding, just key to note here, they have diluted your position over the last 10 years issuing shares. But one thing I would say is, over the last 10 years, you probably wouldn't care given how much that share price has increased, but it'll be interesting to see whether or not they will continue to dilute into the future. ROIC then, return on invested capital, 10% or more to give us faith management are able to effectively allocate their capital. What we would say here is that 2014 to 2019, they didn't turn a profit, so it makes sense why it's negative. Very high in 2022, has come down, trailing 12 month at 10%. It isn't the worst, it is basically the minimum we want to see, but something just to keep an eye on, as it has been coming down over the last 2 years. Operating margin, well, ideally two things we look for in companies that are growing: increasing top line, increasing margin. We've seen their top line increase, although it has slowed down over the last few years. Again, very similar, it has slowed down from 2022 down to 23, expected on a trailing 12 month basis, again lower to 8%. Do keep these things in the back of your mind when we are coming to the valuation. And on the free cash flow margin, as we can see here, 5% as a minimum is what we want to see. Pretty much what we've seen over the last few years, but again, on a trailing 12-month basis, it has lowered to 2%, so just some indicators here to consider moving forward. Net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Remember, number of years it would take the company to pay off all of that debt net of cash on hand. Last few years, well, 0, so that is very positive to note. It won't even take them 1 day to pay it all off. 2024, again, not even 1 day, so it does show their balance sheet does look very strong. So now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So we have the free cash flow year on year. The growth rate has been very skewed, going from negative to positive. Forward looking though, we've gone for 3 different rates. We've started off with a low rate of 25%. Factoring in that with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. And as we can see, an intrinsic value that shows massive overvaluation. Now, there'll be a lot of people there that will say that is too conservative, it should go higher, and that is what we'll do. But on this number, it would be implied downside of negative 28%. If you believe free cash flow will grow at a much rapid rate, then 30% we can see the intrinsic value, whilst we get a sign of overvaluation, pretty much telling us that it is reasonably valued now, as it is around $1 difference from that price. Therefore, the implied upside downside negative 1%. Again, people will say that is still too bearish. There are a lot of catalysts, 35% go higher. So at 35%, a intrinsic value of $244. And as we can see here, this would give implied upside of 35%. Now, don't forget, you can grab a copy of this model by clicking on the pinned comment below, and you can run your own numbers through, whether it's for Tesla, for other companies in your portfolio, or for those on your watch list. Now, as we saw earlier, Cathie Wood does see this going quite high to around $2,600. And for that to effectively happen, what the growth rate would need to be would be around 77%. As we can see, just over $2,500, 78% would give just over. So what she's essentially saying is that over the next 5 years, she does expect their growth rate to be incredibly high, around the 77 to 78% over essentially the next 5 years. Whether or not you agree, because some people will say that is really something out of this world, other people will believe in this company and see a lot of catalysts believing that it will go that high. Always let us know your thoughts in the comments below. But moving forward to essentially the next slide, what we are going to do is run through with the medium rate of 30%. and therefore this will give us our intrinsic value, which is, as we mentioned, just the DCF model today, the most relevant for Tesla. In terms of the current price, well, typically we would use a margin of safety. We would go 10%, which we only execute on if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that for Tesla, then we would see an execution around $161, and then we'd keep going as low until we got our margin of safety. But as we can see in today's episode, it is pretty much, in our opinion, trading at its intrinsic value, so there is no MOS level based on the estimates and judgments we ran through in today's finding. In terms of Wall Street, well, they actually see upside, but very minimally, of only 2%, $183, and as we saw at the beginning of the episode, they do believe this to be a hold. As always though, interested to hear your thoughts. Do you agree with all of these catalysts coming, that they really will propel not just their top line but also the share price? Do you see any of the bearish indicators coming into fruition? Or maybe this is just not one that you are interested in. But as always, do let us know below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.